Hello and welcome back. I'm Steve Murphy, a trust and estates attorney with McGuire Woods LLP, and this is Legacy Planning Once Removed, my podcast on legacy, property, taxes, estate planning, and everything else on my clients' minds. Two of the most popular episodes on this podcast have been about individuals and their approaches to estate planning. And those individuals are Warren Buffett, the famous investor, and Ashton Kutcher, the famous, celebrity and movie star and I guess media personality. Those two individuals you might think have very different approaches to wealth and investment, but actually taking their approaches together, it suggests a different way of thinking about estate planning, and we'll get to that. So let's start with Warren Buffett. There's a recent documentary from HBO called Becoming Warren Buffett. And in that documentary, his daughter Susie recounts a conversation she had with her father. Apparently, after she had her first child, she asked her father, who's very well known and very wealthy at the time, for a loan for $41,000. Apparently, the loan was to renovate her kitchen, to expand it to make room for a high chair for her baby. And she said she wasn't asking for a gift. She said she was asking for an actual loan that she would pay back. And Buffett had a famous response to that request. He apparently told his daughter to, the quote is, go to the bank like everyone else to get the loan. And his idea apparently was to teach his children financial responsibility. They had to go out and get these funds on their own. Now, let's think about that concept and compare it to a conventional trust that might make distributions to individuals over time. That conventional trust isn't really compatible with Warren Buffett's statement. A trust often is about making those discretionary or mandatory distributions to individuals, maybe like Susie, over time. So a trustee really isn't in the position typically to say to the beneficiary, well, just go to the bank and get a loan like everybody else. But we've also talked about maybe an alternative to this kind of trust, and it comes from Ashton Kutcher. In an earlier episode, I recounted an interview that Ashton Kutcher gave in 2018, and he said this. Here's the quote. He said, if my kids want to start a business and they have a good business plan, I'll invest in it, but they're not getting trusts. So you can see how Ashton Kutcher's view of his estate plan is not about gifts. It's not about free distributions. It's about something else. It's about investments in their ideas. But the challenge is how to accomplish Ashton Kutcher's plan after his passing. And we talked about that briefly in some earlier episodes, but let's talk about this concept here. What would it look like if a fund was set up that didn't just make gratuitous discretionary distributions to individuals, but rather enabled some loans or investments? I think of this concept as the family bank. This is an entity, again, not designed to make distributions. This is an entity that is really there to make loans to beneficiaries and, frankly, to expect some form of repayment. We'll get to that. Now, this family bank still might not satisfy Warren Buffett. Remember, he turned down Susie's offer of a loan. He said she had to go to a third-party bank. But there are disadvantages with that approach. A lot of clients don't find that third-party bank option to be satisfactory. And here's just a few ideas. That person might go to the bank and the bank might just not find them creditworthy at all. Or the bank or maybe a credit card company or a personal loan company might offer that loan at really high interest rates. Maybe this individual couldn't get a loan early after they had their first child. They'd have to wait till they were established years and years later. Well, that doesn't help that person after they've had their first kid. And then we can also think about investments in a company. Maybe in the case of Ashton Kutcher, if his child went to a third-party investment bank or venture capital fund, maybe that venture capital fund would really drive a hard bargain and might not be a good equity partner after the investment is made. So in this episode, we're going to recognize the concerns raised by Warren Buffett, and we're going to pursue this structure that Ashton Kutcher laid out. We're going to wonder, what would that family bank look like? Well, I think there are 5 or maybe 6 aspects of this family bank. Number one, I think that family bank should be a separate entity. I don't like the idea of a trust that can make discretionary distributions also being able to make loans. That seems to muddy the waters a little bit about actually the purpose of this entity. So I think it's confusing. So I would encourage instead the client to set up an LLC or a partnership that would receive funds and would exist for this purpose of making loans or investments to beneficiaries. The other benefit of setting up this kind of LLC or partnership is there's tremendous amounts of flexibility with those corporate structures about governance. You could have a board of decision makers, you could specify veto rights, majority rule, who can name their successors, any number of issues regarding governance. And we'll get to that a little bit later too. So again, this isn't just a trust that makes distributions to beneficiaries. We're going to separate this out into a separate fund. But the challenge, and I talk to my clients about this all the time, is that this entity, this family bank, has to be owned by somebody. You can't have an entity that is just freestanding out there that isn't owned by anybody. And so I would say this should actually not be owned by the family members themselves. And that's because if the family members themselves own the family bank, well, ultimately they would have the power to get together and just liquidate the family bank and go against the settlor's intent. So instead, I would suggest that this separate entity, this family bank, be owned by trusts that can be set up as part of the estate plan. Then the trustee of those trusts would be the technical owners of the family bank. And as we've talked about in other episodes, the settlor will trust that they will follow the settlor's wishes about all the investments of the trust, including its interest in this family bank. Now, as you know, on this podcast, I talk a lot about generation skipping transfer tax. And let me just flag an issue here with GST tax. It might seem relatively simple to have some trusts own this LLC. But what we're worried about is potential estate tax or generation skipping transfer tax at the death of the beneficiaries who are the ultimate beneficiaries of these trusts. Now, if the trust is exempt from GST tax, and that's the trust that owns the family bank, we might not have that issue. Those trusts can be set up to last for long periods of time without the imposition of any transfer tax. But a lot of clients like the idea of setting up this family bank with almost the residue of their estate after they use their GST tax exemption. And there's a pitfall there. There's a ticking time bomb of GST tax with that kind of trust and that kind of entity, where years and years from now, all the assets in that trust, and therefore the assets in this family bank too, could trigger GST tax at 40%. There are ways to try to address this, and one way could be including a charity as a beneficiary of the trust, so that even if a generation dies out, that kind of GST, what we call taxable termination, has not happened. That's a very complicated issue, and that's something you can talk to your advisors about. But in any event, we have this separate entity, this separate LLC, and we're going to think of it as the family bank. And I would suggest that it would be owned by trusts for the beneficiary's benefit. All right, the second element of this family bank, we need to be very careful about the investment philosophy of the family bank. This is very important. So we want to think about what kinds of loans or investments would be appropriate from the family bank. This could be investments in specific ventures by the beneficiaries, but it could also make loans for other things. We've talked in episode 20 about how trust assets can be used for the purchase of a residence. We talked about a number of different options in that episode of how a trust could facilitate that kind of loan or distribution. Well, let's add the family bank to that mix as a way to facilitate those kinds of loans. Or we could have loans to enable a beneficiary to go to college or graduate school. Again, maybe facilitating that kind of education with loans from the family bank that really wouldn't be available on favorable terms in other circumstances. And one reason I think this investment philosophy is so important is because many trusts, especially substantial trusts, have a very conservative outlook on investments. A lot of corporate trustees I talk to think about one perspective as thinking of this trust as what they call irreplaceable capital. That is, these assets are not out there to speculate in the market. They are not out there to try to double or triple in value in the short term. Instead, the trustee wants to preserve these assets for future generations through things like diversification in the stock market. Well, if that's the case, then a trustee who wants to focus on irreplaceable capital might not want to invest in a startup by a beneficiary, or might not want to make a large loan to a beneficiary for a specific purpose, because that loan might not get paid back, or that investment might not pan out. So we want to be very careful about that investment philosophy. And in that investment philosophy, we can focus on what's the real purpose of this family bank. Maybe it's not just to protect that irreplaceable capital. Maybe it's to facilitate investments, facilitate entrepreneurship, give beneficiaries freedom and flexibility, allow them to take advantage of opportunities earlier than they otherwise would. We talk a lot in this podcast about ways to use trust to promote agency and independence. And we can also use this family bank as a way to provide mentorship to those beneficiaries so that they're not just going out on their own to invest in a company or to have a startup. They've got that partner right there with them, the individuals involved in the family bank who can help them along. Now, one way to express that investment philosophy might be in a separate letter. I often call this letter the letter of wishes. I know it's not a great name, it's very generic, but we talk about that in episode 24. And that letter of wishes could be a place where the settlor lays out their vision for this family bank. When should investments be approved? What kinds of hard questions should the banker ask before approving it? Or for loans, how should the loans be treated? And that gets us to a third aspect of this family bank. It relates to governance. I think it's really critical for this family bank to have maybe a neutral third party or someone who is willing to push back to these kinds of requests. And those individuals could be on the board of the governance of the family bank, or maybe primarily in control. And those individuals would maybe hear the pitch of the beneficiary who has to say why they think this residence would be a good fit for them and their family, or why this educational program will provide this benefit the settlor intended, or why this investment will pan out. And I say it should be a neutral third party because I would like that neutral third party to be comfortable asking those tough questions and really pushing back. Because again, one of these benefits of this family bank could be this entire process of having a good mentorship of the beneficiary so they understand how best to go forward with these types of loans or investments, and they don't think of it like just free money. Another aspect is to think about protecting the assets of the family bank. Maybe you could require payback of the loan through interest payments, or maybe there could be a plan that the loan will be in place, but the interest and principal could be forgiven over time through distributions. We also want to make sure there's protection of the assets through collateral or security agreements. Again, we don't want to be in the situation where suddenly we've made too many loans or too many investments, and now there aren't sufficient assets to carry out other purposes of the trust. And maybe the last aspect to think about for this family bank is to think about these two related but maybe very different ways that the family bank could operate. Could give a loan to a beneficiary, and again, the loan might just have the purpose of providing that liquidity to the beneficiary, but then getting paid back over time. Or it could offer an investment, an equity investment in a company. And there are other benefits to that type of investment, as I've mentioned before. Now the family bank would actually be a stakeholder in that company and could serve as a mentor and a partner to the beneficiary going forward. So what we've done in this episode is we've started with some ideas from Warren Buffett and Ashton Kutcher, and I've laid out what I would think of as the family bank. Or actually, maybe we could also clarify that it might not be a family bank, might be more like a family venture capital fund. And this is a kind of fund you could set up upon your death. But think about it, all the things I've laid out, there's really no need to wait until your death to set up that kind of fund. These could be conversations you're having right now. It sounds like Ashton Kutcher would like to have the conversations with his children about investments now, during his lifetime, so he could offer his perspective on what kinds of questions to ask and how to be involved in investments. So again, as we sort of often say in this podcast, you could consider starting this process now and not just waiting until your death. So I like to end these episodes with some kind of thought exercise, and maybe it's an obvious one here. Just take a step back and think about your reaction to Warren Buffett. Do you think that was wise advice that he gave to Susie to go to the bank? Do you think that was too conservative? Do you think that really would serve his overall purpose of making sure she learned financial responsibility, or was there a better way to do it? And then think about your reaction to Ashton Kutcher's comments too. We've talked about that on other episodes of this podcast. Should the trust only make investments, or should there be a component where it can make distributions also? So you can consider how a family bank or a family venture capital fund might fit into your estate plan and even to your planning right now. And as I've laid out, these are very complicated. There's various tax issues at play. And so if you're interested in exploring this more, be sure to talk to your estate planning advisor and other advisors about the best structure to use. Well, I'm Steve Murphy, and this has been Legacy Planning Once Removed, my podcast on thoughtful estate planning. Thanks for listening.